Assalamualaikum. My name is Muhammad SYAHIR bin Yahya and my student ID is 2021480844. Today I will present about the consumer credit. So first of all, I will explain the definition of the consumer credit. A consumer credit is the system that allows consumer to borrow the money or incur debt and defer repayment of the money in the future. Having a credit enables consumer to buy goods or assets without having to pay for them in cash at the time of purchase. Most people commonly associate with a credit card. Consumer credit also include other lines of credit and some loans. There are two types of consumer credit, which is the first one is revolving credit and the next type is installment credit. Revolving credit is the person that is approved for a specific amount of credit and can use it whenever he or she needs it, as with a credit card. For the installment credit, the person pays a specific number of payment of a fixed amount until the loan is paid off. Next, I will talk about the advantages and disadvantages of the consumer credit. The advantages of consumer credit is we are able to enjoy goods and services that we want. Second advantages is we are able to combine several purchases in one payment. Next, we can keep our expenses record. And the last advantages is we also can increase our credit score. The disadvantages of consumer credit is we need to pay the money that we borrow with the interest. Second disadvantages is for the customers who fail to pay their balance every month, meanwhile the interest will continue to accrue. Next, the customer will lose their credit reputation. The last disadvantages of consumer credit is the customer has a limitation to spend. That's all from me. I already explained about the definition of consumer credit and advantages and disadvantages of consumer credit. I will pass to the next presenter, Muhammad LUQMAN, to present their topic. Thank you.
Assalamualaikum. My name is Muhammad LUQMAN NURHAKIM and my matric number is 20216200356. I will start my presentation with ways to avoid credit problems. There are 6 ways you can avoid having credit problems. First and foremost, discipline yourself during purchasing goods. Secondly, reducing the number of cards and credit cards limit amount. The third one, prioritizing to pay off first the cards with highest finance charges. Other than that, limit new charges. The next one is always paying more than the minimum. And last but not least, transfer balance to cards with low interest rates. That's all from me. I will pass this presentation back to Muhammad SYAHIR. Thank you.
Thank you to Muhammad LUQMAN. Next, I will talk about the calculation to find out that you are in too much debt. Before we want to take out a loan, ask yourself this question. Can you afford the loan? Or what do you plan to give up in order to make the payment? Or are you prepared to make this trade-off? So to calculate, we can use the formulas from the debt payments to income ratio. The formula is the monthly payment will divided by the net monthly income times by the 100. However, your debt doesn't include all of your monthly expenditure, but does include the following, such as monthly credit card payments, alimony, or a child support. Things that shouldn't be calculated as part of your debt to income ratio include the internet, cable or electricity. So in order to be able to go on credit, make sure that the percentage that we calculate is not exceeding than 30%. If the amount that we calculate is below than 30%, we are able to go on credit. But if the amount that we calculate is more than 30%, so we are not able to go on credit. Here are some examples. If your monthly income is 3,000 ringgit and your monthly debts are 500 ringgit, your debt to income ratio would be 70%. That is a good number to be at and it is considered low by the lender. Next, I will pass it back to my partner LUQMAN to continue their presentation. Thank you.
Thank you, Muhammad SYAHIR. So for the next topic, I will explain about factors when choosing financial. Let's start with margin of financing. Margin of financing is the amount of the loan that the financial institution is willing to provide, stated as a percentage of the value of the property that will be used as security for the loan. The next one is processing fees. Processing fees, which are imposed by credit card companies on every transaction made with a credit card, range from around 1.3% to 3.5% of the transaction total. The precise sum is determined by a number of factors, including the payment network, such as Visa, MasterCard, Discovers, or American Express, the type of credit card accepted, and the merchant category code MCC of the company that using the credit card. The third one is repayment schedule. Repayment schedule is the schedule of payments that shows when the borrower has to pay back the loan, interest, and any other payments that are part of the loan agreement. The next one will include collateral. Collateral is a thing that a lender will take as security for a loan. Depending on what the loan is for, the collateral could be a house or some other kind of asset. The collateral is a way for the lender to protect himself. The last one will be cost of financing. The cost of financing includes the principal, interest, and any other fees that are associated with the borrowing of money for the purpose of constructing or purchasing assets. This can include the cost of obtaining a mortgage on a home, the cost of obtaining a car loan through a bank, or the cost of obtaining a student loan. So why did we use credit? First of all, it is to meet financial emergencies. The second one will be to avoid paying cash for large outlays. The third one is for investment purposes. So I will pass this presentation to the next presenter, which is Abdul MUTALIB. And thank you very much for lending your ears.
Assalamualaikum warahmatullahi wabarakatuh. My name is Abdul MUTALIB bin Azman. My matric number is 2021889362. I and AFIQ will present about insurance planning. The definition of insurance planning is a contract in which an individual or entity receive a financial protection or compensation from an insurance provider in the form of policy. In a simple word, insurance is a protection if something happens to us, such as accident or unemployment. There are a few general functions of insurance. Firstly, it replaces the income after the insured died. Insurance company will pay the insurance beneficiaries, such as their family or relative, according to the agreements. It is very important for their family if the insured are the only sources of income for their family, as it will reduce their burden. Secondly, to pay medical bills. When the policyholder is having a serious disease or unexpected accident, insurance company can help to pay the medical bills. Third is provide cost of children education. It is specifically designed as a saving tools to provide funds, since the cost of education are constantly increased due to the inflation. Fourth is to pay off families' outstanding loans. As example, the policyholder lost their ability to pay debt due to disability or unemployment. This insurance can help to cover the monthly loan payment or protect the insurance from the default. Last but not least, as a fund for retirement expenses, insurance have an investment component that allow policyholder to grow their wealth on the taxation basis.
Assalamualaikum warahmatullahi wabarakatuh. My name is Afidin Ibn Sazali and my matric number is 2021470616. So I'm going to continue our presentation with benefits of insurance planning. Firstly is to providing security. There is always a fear of sudden loss, so insurance provide a cover against any sudden loss. Next is spreading risk. Whenever a loss occurs, the insurance is compensated out of the fund for the insurer. After that is source for collecting funds. The insurance pays a premium to the insurer in exchange of insurance coverage. Large funds are collected by way of a premium. Besides that is encourage saving. The insurance develops a habit of saving money by paying premium. And lastly is encourage international trade. In the presence of insurance, the trader will not be worried for the safe arrival of goods to the other country. Next, I will continue to talk about tips of buying insurance. There are many tips to be considered before buying an insurance. Firstly, is sure to buy from a company through an authorized agent. Make sure the agent is registered under a legal company. Next, is shop around for the rates to get the lowest price with the same offer benefits. Besides that, is understand the scope of cover, terms and condition of the policy. Prepare a question to ask for your understanding about the policy. Moreover, is to avoid unwanted additional coverage and just take coverage that is suitable for you. And lastly, is make sure the life policy recommended is right for us.
There are several types of insurance. Firstly is life insurance. It's ensuring that immediate family has some financial support after the insured death. Secondly, we have medical and health insurance. It is designed to cover the cost of private medical treatment to provide us with an income stream while undergo treatment. Third, we have investment-linked insurance. It is a life insurance plan that combines investment and protection together. Fourth is education insurance. This insurance provides the funds needed by the child to pursue further education.
For the next part, I will talk about types of insurance. Firstly is home insurance. There are three types of home insurance. That is basic fire policy, house owner policy, and householder policy. Next is personal accident insurance that provide coverage for risk of injuries to the body that may be a result of an accident. Besides that is motor insurance that provide coverage for vehicle owners to protect them for incurring any financial loss. And finally is travel insurance that provide coverage for medical expenses, financial and other losses incurred while traveling.
We move on to two types of insurance, which is Islamic insurance and conventional insurance. I will explain first about the conventional insurance. It is a policy that shifts the risk to the insurance company. We need to pay a premium to receive the coverage. On conventional insurance, we have life insurance that gives certain amount of money to the insured beneficiaries when the insured dies, and general insurance cover other items excluding the life insurance. This investment is subject to government's law only, so they can invest in any kind of investment without care about the interest, gambling, and uncertainty element. Besides that, risks are transferred from individual to conventional insurance provider. This insurance for sure practicing interest in their transaction because they only follow the government's law only. Lastly, the profit in the investment are subject to the company. Only dividends are returned to the shareholder.
Finally, I'm going to explain about Islamic insurance. They also call it as takaful. Takaful offer insurance in a type of family takaful and general insurance. General insurance works similarly to conventional insurance while maintaining Sharia compliance, while family takaful helps to protect the insured from risk and help to grow a long-term savings. Next, takaful investment will follow strict principle. Takaful cannot invest in anything that has element of gambling, uncertainty, or the practice of lending money at unreasonable higher interest rate. Moreover, takaful is based on shared risk. Each participant donates to a takaful fund, and in the event of loss, the participant will receive the amount of its claim. There will be no interest occur in takaful. And lastly, for the profits, if there is an extra money because of low claim rates by the insurer, it will be distributed equally to the participants, while the profits from the investment will be distributed to the both participants and shareholders. That's all from us, and thank you. Let's continue with a Q&A question.